Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we'll have a look at an update of some of the data points that we've been tracking with regards to the war in Iran. We'll look at signs that the US economy was slowing even ahead of the war. We'll also look at indicators that show that the US at the moment is anything but cheap. And finally, we'll have a look at market expectations for the SARB. We're going to start off with the usual metrics that we're tracking in the Middle East. As a starting point, if you look at the number of tankers passing through the Strait of Hormuz in one direction, the 7-day average of that is now sitting at 2, down from about 200 prior to the war. So quite clearly there is a restriction on tankers passing through, which means that we need to pencil in reduced supply of crude, of gas, of fertilizer inputs, of aluminium, of helium, a variety of different inputs for the global economy. And that will have knock-on consequences. And the key question that we need to ask is A, whether central banks will see through that, will see through the short-term price increases, hopefully they're short-term, and B, to what extent do we see a fall-off in economic activity. Even should the war end overnight, it is still going to take some time for inventories to be rebuilt in a variety of different commodities, and it does just suggest that we are potentially looking at a price squeeze, a further continuing price squeeze for a variety of key inputs for the global economy. So first of all, we need to ask, when is this war likely to end? Well, if you look at the betting market, what's currently priced in is about a 50% chance of a ceasefire by the end of May. So another 2 months to go. And if you look at the probability of US forces entering into Iran by the end of April, that's currently sitting at about 60% in the betting market. So it could still be the case that for a variety of metrics, this gets worse before it gets better, and we're landing up with further supply shortages for, again, a variety of different commodities. Crude is pretty important at the top of the list. If you look at what's currently priced into the betting market, there's about a 90% chance that crude is still above $100 per barrel by the end of June. And an over 60% chance that it's above $120 per barrel. And the net result of that is a pretty sizable increase in inflation. It changes the trajectory for US inflation quite materially. It will likely increase US inflation by over 0.7%. just for the next month's reading, for March's reading. So we could land up with a pretty sizable increase in inflation across the globe. And hopefully central banks will see through it. And if you look at what's priced in, central banks aren't expected to act immediately. But the ECB, as an example, is expected to hike by 3 times over the coming year. The Fed, not yet. And that is going to be a key driving force for markets. And we need to keep a very close eye on interest rate expectations in the US in particular. Speaking of the US, while there's a gas shortage in Europe, and we're going to come back to that point, in Waha, which is a hub in the Permian Basin, natural gas prices at the moment are negative. There's not enough storage in the immediate vicinity, not enough ability to shift it over to other parts of the world like Europe. So as a result, producers at the moment are paying people to take gas off their hands, while in Europe, we've got a shortage. It is just quite remarkable. And even in other parts of the US, prices are high. If you look at the difference between a Henry Hub price and a Waha price, that difference has surged quite materially. So there's not just that there's a gas shortage. There's a shortage of ability to get gas out of the Permian Basin and parts of the US to other parts of the US and to Europe. And as a result, the European gas price is multiples of that in the US. And we think that that will subsequently lead to higher inflation in Europe in the near term, and an increase in electricity prices too. And that too will have a knock-on consequence for growth. So it's going to be a pretty important component of the global economy to watch. That is how gas prices shift and are different in different parts of the world, and what that ultimately means for inflation and growth in each region. Just coming back to the US, we're now seeing a couple of indicators that the US economy was actually slowing even ahead of the war. The latest indicator, which came out last week, was US construction spend, which was down 0.3% month on month in January. That was below the consensus number. And that number has now been negative for 3 of the past 5 months, again suggesting that construction activity was slowing, and that too would be affected by what's happening at the moment in the Middle East, what's happening in Iran in particular. And we may well be sitting in a situation where the US economy was slowing, ahead of what is likely to be a pretty sizable energy shock, even for the US. It'll be greater for Europe, but nonetheless, because of the spike in crude, it will still be sizable for the US. Which leads one to question why the US market is still as expensive as it is. And we can see that using a variety of different measures. If, for example, you look at the 12-month forward PE ratio, for the US, that's currently sitting at 20, which is quite high relative to what we've seen over the past 20 years. If you look at price to book, it's above 5, which is close to the top end of the spectrum of what we've seen in the last 20 years. And EV/EBITDA, another valuation metric, it's also looking pretty elevated. So one would say that there isn't a sizable margin of safety in the US at the moment. And I think one of the reasons for that is still quite bullish earnings expectations. If you look at earnings expectations for Q1, which is now coming to an end, the current consensus forecast is that earnings growth was around about 13% year on year, which is pretty good. It'll be the fifth quarter in a row that earnings growth has been double digit. If you look at what analysts are penciling in, the percentage of stocks in the US that are on buy recommendations is the highest that we've seen in many years. And if you look at bottom-up expectations for target prices for companies, those numbers are still pretty elevated as well. So analysts haven't yet started to pencil in the knock-on consequences of the war in Iran into their numbers, and that is providing, I suspect, some support for the S&P 500. And once analysts start to become a bit more bearish, once they start to pencil in some of the concerns that we've been talking about, that is likely to be a headwind for the S&P 500. And finally, in South Africa, there's a question around what's priced in for the Reserve Bank over the coming few years. Last week, the SARB didn't change rates, but they did indicate that if oil was above $100 per barrel for 2 months, that would call for a hike by year end. Now, the betting market is pricing that in as a base case. The market at the moment, with regards to expectations for the SARB, is pricing in 3 to 4 hikes over the coming year. Now, that comes at a point where growth last year already disappointed and consumers in SA are already under significant pressure. So this could well shift the trajectory for SA Inc., your typical interest rate plays in South Africa. And this is something we need to keep a very close eye on. Guidance from the SARB is going to be critical. But as things stand at the moment, the trajectory for interest rates in South Africa has shifted materially, and the outlook for SA Inc. has weakened too as a result of that. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider and a registered credit provider.